I really like the Jade Lizard because it gives you a pretty far break even and you can eliminate the risk to one side, usually the upside for me.
Today, we will dig into a high probability options strategy with no risk to the upside. We're talking about Jade Lizard and its sibling, Big Lizard. From New Hampshire, welcome Ross Young.
Hi, John. Good to be with you again.
Ross, one of your favorite strategies is Jade Lizard. Why is that?
I really like the Jade Lizard because it gives you a pretty far break even and you can eliminate the risk to one side, usually the upside for me. And yeah, that makes it a very interesting trade.
And we will dig into all the details of how you trade this specific strategy and also Big Lizard, which is a variation of the same strategy. But tell us first, how would you characterize yourself as an options trader?
I think especially nowadays, I'm getting a little older, a little more cautious. And that's what I'd like about the lizards is they give me further break evens, eliminate risk to one side, and I can get a little bit more comfortable there. I guess after our last conversation, I realized I'm pretty diversified because I do a lot of different things as a trader, but I'm trying to manage risk and reward all the time. So I've got some caution.
So let's dig into it. What exactly is the Jade Lizard?
Well, the Jade Lizard trades, and these are all going off my head here. I'm not a professional options instructor or anything, but I'll tell you from my experience, it was a trade created by Liz and Jenny on the Tasty Live network. And the Jade Lizard is basically the short put with an added call spread on top. And the call spread has got to be smaller than the total credit. And that means you're going to eliminate the risk to the upside. If it goes through your call spread, you will make a very small profit. But if it stays anywhere between the put and the call spread, you'll make your full profit if you took it all the way to expiration.
All right, so maybe we should do an example. We have one here with GDX. What do we see?
That sounds good. Yeah. GDX, gold miners, ETF, it's pretty liquid. And you do need good liquidity to trade these things because you've got three legs. Now, whenever I'm setting up one of these, the thing I start with is the put, and it's not delta based really, it's credit based. So I'm looking for credit around 70 cents or a little bit better than 70 cents. And that sets my short put.
And in this case here, we are receiving 79 cents with the strike 49.
Perfect. And then our current price is 53. So we're a few dollars below that. Nice spot. And then I'm looking for a credit spread above this, and I got to keep that narrow. So in this case, we're going to keep it to $1 wide, and the credit spread is probably paying 20 something cents here.
Receiving 125 on the one with soil, and then we are paying 103 for the long. So
Yep.
around 25 cents. Yes.
Right. And the two of those combined, the $1 credit spread with a little bit and the short put spread with 70 something cents together will be just over $1. The width of our credit spread is $1. There is no risk to the upside. If this underlying goes to the moon, we don't lose anything. We actually make a very small credit on this one, just 50 cents. But the advantage is it eliminates upside risk. And the other advantage here is our break evens are further than just the short put. The short put at 49 would be our 70 something cents. Under that is our break even, but we've added the credit from the short credit spread on top of that. Gives us a little bit further break even there.
And this is how it would look at the expiration. But we could, of course, look very quickly at the profit loss, how it develops during the trade. This is a 45-day to expiration example. And this is how it looks. The thick line is the situation right now, and the thinnest dotted line is where it will be at expiration. So as the time passes, we see that the break-even points is going, current break-even point is going lower. And then finally we end up at expiration with the profit loss curve we saw.
What I like about this is the width and the distance to the break even. I've got a lot of room in here. I'm not worried about anything to the upside. I first started trading these because strangles that I had the call would get run over and I'd have to deal with that, take losses to the upside. So this eliminated my loss to one side. It's a much smaller credit, but a higher probability of profit in the end.
And I guess many have had that experience if you're selling iron condors regularly and it looks fine and you're sure it cannot move that much, but then the market jumps up as the market does sometimes. And suddenly you are losing on your trades.
Right. It does what we're not expecting.
So Russ, what are the best conditions for these type of trades?
Well, the IV is certainly an advantage. You want volatility. You want some IV in there to get paid for the risk that you're taking. And, price of the underlying is significant. You want liquidity because we're selling 3 legs. If it's an illiquid product, it's going to be much more difficult because you're going to be giving up a little bit on each leg. For myself, I do like it if I'm slightly bullish. This can be a neutral to bullish trade, but really it's going to be best if nothing happens, if the stock just kind of stays in between the 2 short strikes.
And you explained the mechanics for how you set it up. You run it by the premium you expect to get. To repeat, you aim for about 70 cents on the put side.
Yeah, that's really how it'll start, is I start looking for that. And then I can decide if I'm more comfortable bringing that put up and the credit's going to get bigger. If it gets closer to $2, that credit spread can then pop open to $2. Really, I just want to keep the total credit bigger than the credit spread, and that eliminates my risk to the upside. The further my put can be down, gives me a greater break even to the downside. The downside break even is really the advantage, and then having no upside risk is the advantage. It's a great trade for somebody who's been selling short puts and wants to do a little bit more, but might be nervous about risk to the upside, or just wants to see some more things happen. This has got more stuff going on in here.
What are your favorite underlyings and also days to expiration with this system?
I like liquid things for the ETFs, and I like them to be cheaper for these so that I can start with a dollar wide call spread, which that limits us to being less expensive underlyings, but they got to be liquid. So a lot of the liquid ETFs like GDX and GDXJ, one of those we just looked at. And I'm also thinking of a buying power that's going to restrict me. So yeah, smaller is better in general, but it's got to be liquid. It's got to have good high IV. I will look at the liquid products. If there's a stock I have or I've traded, I'll look at them and I'll compare them sometimes, but the math doesn't always work out because I'm giving up too much on each leg, and yeah, it makes it really not worth it. So I might just end up just selling a short put in something that's less liquid.
How many days to expirations do you prefer?
45 is what I've been targeting. I'll go a little bit longer with these if I need to, maybe 60, but I haven't traded much beyond that. I've always kept it in that shorter range so that theta can come in more quickly for me.
How do you manage them?
Well, this is where you get a little bit more going on than the short put, where there's not too much to do with the short put. You're probably just going to take your profits, maybe roll it up. But here, if it goes to the upside, mostly you just consider one trade and you take your win. You take your small win, or you set a good till canceled to take it at that dollar profit or the dollar debit, making your small teeny credit, whatever is to the upside. Sometimes I think 50 cents in our example might be a couple of dollars, but it's not much. You can roll that put up. You just have to realize if you do that, you are bringing your break even up as well with it. So I don't really like to roll my puts up because it brings up my break even. So I try not to do that. I just consider it all one trade and I'll take it off for the small credit if the price goes up through my calls. If it comes down, I will roll the calls down if I can. Now the space between the wider I started really wide between the put and the short call spread, I have the ability to roll that call spread down, sometimes a couple of times if I need to, for small credits each time. And then the last roll will be to match up the 2 strikes, the short call and the short put, the same put. I'm going to roll the whole call spread. I don't want to widen the call spread because it could then add risks to the upside. But if I'm just rolling the whole spread down, it continues to say, oh, you still have no risk to the upside. It gives me a little bit more room to the break even to the downside and adds a little bit more credit on there. That's how I'll manage it in the one expiration. I also will roll these out. If IV remains high and I can get a credit to roll things out, I will do that. Now there's 2 ways to do it. Probably the easiest is just to close the trade and reopen a new trade. I will roll one at a time. So I'll roll the short put out and then I'll roll the call spread because you can't roll 3 legs into 3 legs. At least I haven't seen a place that'll let you do that. But I can roll the put out for a credit and roll the call spread out for a small credit.
What's the worst that can happen with this trade?
Well, the risk is on the downside. So if the trade falls or if the underlying falls complete through your short put, you're going to have to roll or possibly take shares. Usually I'm looking to roll, and let's say it goes straight through my put spread, my short put, and I've already rolled my calls down so they're all the same. I will close that trade and reopen or roll the whole thing out. And hopefully it's still worthwhile to keep the call spread on there. Then I will also watch the total credit that the trade has received, and I can widen the call spread appropriate to whatever credit I've received. So if I've rolled it a couple of times and it's gone up to $2 credit, that if we're on GDX, for example, I can widen that call spread to $2 and take in a little bit more. And that works, especially as I'm going out into time. So if we've gone 1 month to another and then a third month, and I have a couple of these that I've fought for many months, I can think of one that went beyond a year and turned out pretty good in the end. It has a good ending story, but it was sweating in between, fighting the battles and adding and rolling and moving, but came out okay.
Will you sometimes just take the shares?
Yeah, I will take the shares if it's something I'm interested in. Nowadays, those tend to be dividend payers, but remember, it had to be liquid to start with. The one I was thinking of that took a long time to come in was GDXJ. Started with a regular old Jade Lizard, the very inexpensive, just $1, maybe paid $1.10, $1.20. Had to roll down, had to roll out. At some points in the trade, it was not a Jade Lizard. In some points in the trade, it was just a short put, meaning it didn't pay me enough to keep the call spread on top. It was only $1 or $2, pennies really in the options world. And then in the end, I actually do take shares and was covered good. So anyway, it's more exciting. There's more stuff to do if you're comfortable with the risks that you're taking.
I guess that for those trading the wheel, this is kind of a way to boost your cash secure put a little bit because you get cost there on top.
Exactly. It's the short put. You can think of that as the wheel spread with a kicker call spread that gives you a little bit of boost.
What would you say are the main pros and cons with this strategy?
Yeah, the pro is definitely the break even. I get a break even to the downside. Break even is really far and I have no risk to one side. Those are really the pros. The risks are the credit is small. They're not usually that big. You can do much more exciting trades where the deltas are higher, the call spread is wider, but then there's always a trade-off in everything. You're going to say, oh, now I have risk to the upside. Now my break even has come up further. So yeah, that's the pros and cons.
But what role does it play in your own overall trading? How does it fit with the other strategies that you do?
Yeah, it's not the most common one I do, but I'll definitely look at it every time I've got an underlying that I'm looking at. That's the first thing there. It has to have strikes that are available to be able to fit a nice smaller call spread in there. So if it's $5 or $10 wide strikes, tougher to do that. It's possible, but it's more difficult to do it. That's why the GDX and GDXJ and smaller ETFs work really well to do this, or liquid underlyings. How many of these do I have on? I don't know how many out of the whole thing. I don't have a standard of how many I'll keep on, but I'm sure I have a couple all the time that I'm trading.
And then we have the sibling trade, Big Lizard. What's that?
Really, how to get to this one from the other is if you're trading a couple contracts of the Jade Lizard and you want to trade 5 of these $1 wide Jade Lizards and you're trying to boost the credit that you're taking in by adding on contracts, you could instead go to a Big Lizard, which is going to bring in a bigger credit and just one contract of those. So I think of it as if you're going to have 5 risks to the downside with a far break even, it might be better to just have one contract risk to the downside and bring your break even up a little. And that's the how we're getting there and why we're doing it. Now, the what is it? It's the same thing. It's a short put and the short call spread, but we're going to bring the two right together. So really, instead of starting with just a short put, we'll start with a short straddle, really at the money straddle right there. And then depending on the credit that we're getting, which is going to be a very, very good credit, we'll put that long call on top to make sure that it gives us no risk to the upside. So if the credit is, $11, I don't want to pay any more than $11 for that call spread, the long call on top that caps our risk.
So maybe we should bring up our example again. And it's the Jade Lizard on GDX that we had. What should we do now to create a big lizard out of this trade?
Yeah, I would bring them right to both short strikes right to 54.
Okay, so we bring up put, and then we bring down the short call. And where would you like the long call?
Well, let's see what our credit is here. Credit is 429, and we are at, let's see, a 5. So the chart shows it perfectly. You can see to the right, there's a little bit of a loss if it comes up. So let's bring that 59 into 58 and see how that does.
Mm-hmm.
And there we go. So we're almost nothing at the upside, just a few dollars, 407. This is great. This gives us the widest break evens and a $407 credit if it stays right here.
Great. And what's the best conditions for this as opposed to the Jade Lizard?
Again, high IV. I will look at them both back and forth. The major differences in the trade-offs really here is if I'm in a Jade Lizard, I got a wide break even. If I'm in a big lizard, that break even comes way up. But I get a whole lot more money, a much bigger credit in the big lizard than I did in the Jade Lizard. The Jade Lizard, I'm giving up a big credit, and the big lizard, I'm getting a big credit. Both of them are bullish, neutral to bullish trades. You can play with where are the two things going to go, but that's on sort of personal preference. What do you like here? On that last example, I might even bring that call down one more strike so that I have a little bit more credit if it's going to go up to the upside, but that does bring in my break even each time I do it. But those are the things I'll play with anytime I've got an underlying in here. What's the Jade Lizard going to look like? What's the big lizard going to look like? And am I comfortable with the break evens and the credit that I'm going to receive?
And if you want to bring a long call one step further, we will get it like this.
Right. So here it's a $3 wide call and I'm going to get 378. So I know to the upside, the worst case scenario is I'm going to make $78. It did bring my break even to the downside up a little bit. And that's what I'll play with a little bit when I set this up. I don't automatically go up. I'm getting paid $4 and I got a $4 wide. Let's go. I'll bring it in and say, okay, well, this is a little bit more upside credit if it runs up.
And what are the biggest risks?
Yeah, the biggest risk is the downside here. All the risk is to the downside. If you've set it up right, all the risk is to the downside. And the break even is higher than the Jade Lizard there. So you got to know that going in, that you didn't have that far break even way out. It's a lot closer.
How would you manage this compared to the Jade Lizard?
In the same expiration, there's a lot less to do. There's nowhere to roll that call spread. So this is on until you decide to try to roll it out in time, or take it off it for either the credit or a loss. I'll roll them out in time. And this is where I'm thinking about how much buying power is this holding up, and am I going to get something to be able to roll it out for? I want to be able to bring in some percentage of return on this, hopefully 1% if I'm going to roll it out. But usually these are easy if the price is around that, your strikes and the IV is high, it's probably going to make sense to roll it. It has been in my experience anyway, that I continue to roll it. I've got one right now in, what is that in? I think Exxon Mobil, and it's doing that. It's kind of just, the price has come below my strikes and it's already profitable slightly, but if it hangs in there a little bit around here, it'll probably make sense if IV stays high to roll it out and do the whole thing again, close it down and reopen, or roll one chunk at a time, the calls and then the put, or the put and then the calls.
Do you have a preset profit level where you pick the trade off?
Yeah, I mean, I'm looking for 50% in the Jade Lizard. If it runs up, I will take it early. If either of these move quickly or come in quickly, I'll take a smaller percentage in less time. I'll take them off at 50% if I can. The big lizard is usually going to be less than that because it's a straddle. So, 25 to 30% is going to be a good thing. Everything's playing it my way, I'll keep them going.
What have been your overall results trading Jade Lizard and Big Lizards, respectively?
Good question on the overall result. I would say I don't have a percentage on the winners and losers, but I think these are high percent win trades. The Jade Lizard bigger than the Big Lizard. And the other thing that adds on the winning percentage is that I roll them out of time, that I will keep fighting the battle if it makes sense, if I've got some IV and if I can continue making credit on the risk that I'm taking on the buying power that's holding up. I wish I could put a number on there, but I think that it is difficult because I roll them out, because they're not all one-offs. And I think that is, for just a little backing up on options trading, we can look at any trade in sort of a vacuum and see what happens over time. Like I love your chart and see what happens over time. But I think the real advantage is how do you manage things and how do you roll them and what can you do once the trade is on? You don't just have to sit, when you explain to somebody, we're always saying, this is the option and here's the case at expiration. It's really the in-between world that gives you all the benefit. It's not just that one math equation of where you're going to be at expiration, but how do I manage this? How do I roll it out in time? How do I keep bringing in some more theta? Those are the real advantages, which unfortunately mean I don't have a percentage. I mean, I guess if you pin me down and say how many are winners and how many are losers, it's got to be close to 90% winners. I know that's a big number, but remember, I've fought one for probably, it's at least 2 years. I took a GDXJ and wrestled around with it. So I'm a little bit stubborn in that sense. But probably the 80s, I guess, if I had to nail it down, but I don't know. I'm sure I've got some losers, but I fight the battle. I roll them out and keep fighting if I can.
You keep rolling, you say, but
I can.
rolling can sometimes also add to a loss, at least if you do it in the wrong way. Do you have a set level where enough is enough? I'm just going to have to take the loss and close everything.
When I'm smart enough, yes. When I'm smart enough, yes. It's really a 3x loss is kind of the standard thing I have in my head. When I've been mechanical with that, I've probably been the most successful. It's when and these are the risks that you let your emotions get involved and you think, well, it's come down, it's got to come back up, or gosh, worst case, which I don't do this often, but I have done it, is you throw good money after bad. And you go, well, how about another Jade Lizard just below this one and we can keep 2 running? And it's been a while since I've done that. But those would be the lost things where it came down through my short put. I maybe took shares and now the shares doesn't make sense to sell calls against them. Those are the bad scenarios that having your mental, how do I get out of this, is really good. You get into a trade, you say, oh, it's going to be GDX, for example. It's going to be the $1. I will get rid of this if I roll down the credit and the total credit or the trade is worth 3 times the total credit. Get rid of it. Right.
Ross, I like to ask my guests to place their strategy on a risk scale from 1, very low risk, 10, very high risk. Where would you place these strategies on a risk scale like that?
Well, if we have a short put, do you have a number for a short put?
This is all up to yours.
Yeah. If you say a short put is a 5, for example, this is lower than the short put. And I would put the Jade Lizard, maybe, let's just say the short put is a 5. The Jade Lizard might be a 3 and the Big Lizard might be a 4. So they're less risky than the short puts. And you're going to get some additional credits on there, but depending on which of those 2 trades you have, the break even changes.
Let's sum up what we've been through, Ross. What would be your 3 to 4 most important tips to someone who are interested in getting into these 2 strategies?
I think you have to know what you're getting into for the risk. There is risk to the downside, and you have to keep the call spread small enough that there's no risk to the upside. So they're good trades to maybe experiment what you might do if you want to do a strangle, but you're a little bit nervous there. Yeah, I think they're really good trades when you're not quite sure what to do. I'm not sure if I'm neutral or bullish. This is perfect. Maybe I'm a little bullish, but I'm a little nervous. This is a good trade to do. You have all kinds of the same type of trade. This is something different that has components on both sides. So it's a little more interesting than just selling short puts.
Do you ever reverse them so that all the risk is to the upside?
Yes, you can do it. And I've done a couple of reverses. I can't think of the underlyings I've done that on right now. Well, me, since I'm a little more cautious, if I had shares, then I'm much more likely to be able to do a reverse because I've already got shares and any call I sell is covered already. So yeah, they would be single naked call, and then a short put spread underneath. Except for me, I much more prefer that trade if I have shares, and then that call is not naked anymore; it's now covered. But yeah, you could certainly do that. That might be a preferential treatment of looking at where the price is and what you're expecting. So if it's maybe very high, it's on its highs, and you're expecting a pullback there, I can see someone wanting to put on a trade like that there.
Where would be a good place to learn more about these strategies?
Well, the originators and the inventors of this, Liz and Jenny on Tasty Live, they are the masters, and they've got a couple other variations as well. Those are the two that I trade. Yeah, they have a bunch of videos about it, and they're probably a lot smarter than me.
And if you are interested in learning more about Ross' own trading, we did another interview with him a few weeks, and the link to that video will pop up on the screen. Thank you very much, Ross, for sharing how you trade these strategies with us.
Well, thanks for having me, and thanks for talking. I appreciate it.